Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review for the week ending May 19, 2023. So let's start with a look at this week's markets at the close on Thursday. So some red and some black, negative for bonds, meaning that rates were higher. There is some optimism about a debt ceiling deal being in reach in the US. Mr. Biden and Mr. McCarthy have both been vocal about that. They're guiding to some progress, which is nice. In the US, there's always a scare around the debt ceiling deals, and they always take it to the line, but they find a way in the end. So the history has been that. So it's good to remain constructive here, maybe to not take excessive risks going into the final stretch. But as Winston Churchill used to say, you can always count on the Americans to do the right thing, but after they've tried everything else. So this is the kind of way that they tend to operate, and we're still optimistic that something will be getting done and we won't go into a full-on default, because that would be uncharted territory, could be very costly on an economic basis, and no one wants to get there. So they're talking, and a deal seems to be in reach, which is positive. Also, inflation was higher than expected this month in Canada, so that pushed interest rates higher on the week. More on that in a few minutes. The US stock market outperformed with the optimism that is starting to make its way into the markets. Oil was higher, and the price of gold, because less risk seen on the debt ceiling issues, mean that the price of gold lost some of its luster. Now we're at 1950-ish on the price of gold. So inflation, slight rebound in April in Canada. That was a surprise. The markets were expecting inflation to continue to slide down. The pace of month-over-month inflation has been strong recently, which explains why we've seen this bit of a rebound here. But remember that when you look at year-over-year inflation, well, it's a sliding window. So now we're looking at April 2022 to April 2023, and it was in early 2022 that we had the strongest monthly prints on inflation. So now they're sliding out of the year-over-year window, which is pushing the figure down. But if you look on the right, month over month, you're seeing some verve 0.4, 0.5%, and now 0.7% month over month. So if you annualize that, you still see a strong underlying pace. But still, I want to make the case here for the Bank of Canada to not go forward with another rate hike. I know that they're considering it. They've been vocal about it. They need to stay nimble. They need to make sure that the inflation beast is tamed. But as we've shown 2 weeks ago in the last review that was released, well, its monetary policy operates with a lag of 18 to 24 months, and before it hits inflation, it needs to hit consumption, then businesses, and then the economy. And there's a sequence there, so it's normal that we don't see yet inflation being tamed. And of course, the big one, which was July 2022, when we saw a 100 basis point hike by the bank. Well, that was 10 months ago. That was not 12 months, 18, 24 months. That was just 10 months ago. So it's normal that we don't yet see it bite as much. So there is a risk, maybe if later this year we're still in this situation, the bank will be forced to go with another hike. But right now, we still think it's a time for patience. And if we look at what to expect by year end, so just scenarios here. So the chart, the solid line that you see is the past. So the history of the year-over-year inflation in Canada, and all of the lines after that, they're scenarios. So we look at what would happen if, starting from today, every single month was 0.4% month over month. That would be the red line. And then 0.3% month over month. That would be the gray line. And then you go to 0.2, 0.10, and even negative. And what's interesting is that almost whatever the scenario we're looking at, we should see another steep drop in the coming month or two. And then after that, we should start to see a rebound. And the strength of that rebound will depend on the strength of the month-over-month figures that we'll continue to see moving forward. So now is the time for patience. Now is the time to see if we've done enough, because we've done a lot. of tightening. It's not time to overreact, because what happens with the Bank of Canada, it has, well, monetary policy, it has a lingering impact on the economy. And what a very good way to illustrate that is some charts that were released this week in the Financial System Review from the Bank of Canada. So about two here. On the left, you see that it's going to take until late 2026 before every mortgage in Canada has adjusted to the new regime of higher rates. So there's fixed and there's variable mortgages in Canada. It's about 70 to 80% fixed. Generally, depends on, there was lots of interest for variable mortgages in 2021 and 2022, but generally it's between 70 and 80% that are fixed, and they're fixed for 5 years. So they need to be, so they're not all renewed at once. So the impact is staggered through time. So we're going to be seeing the impact filter through time. So if we do too much here, we could have an impact that is lingering for some households. So there's that. And on the right, again, the impact, depending on if you had a variable or a fixed mortgage. Well, variable mortgage households pretty much have all of the impact already. So they're already adjusting their spending, and this is the economic impact that you want from monetary policy. But for mortgage rates, for mortgages that were more and more fixed, when you move on the right here, see that it's going to take a few years again for the impact to dissipate. So this is the lag that we're talking about. It's not instantaneous, and you need to see the economy slow down enough for conditions to rebalance, for inflation to get back to 2%. And there's a risk of doing too much now if you're too much in a hurry, because after that you can carry some of that impact for a while if you don't do the right thing. So patience during the summer, and if at the end of the year we see that the month-over-month figures remain too strong, then maybe it's going to be well advised to hike, but not yet. So in the Bank of Canada, the market expectations now are for another hike by September of this year. So we think it's too much, and we would take the other side of that trade. So this is what this chart is telling us here. So what to watch next week? We'll have the CFIB Business Barometer coming out, and in the US, we'll have the S&P Global US Manufacturing PMI, which always comes 1 week ahead of the ISM. So it should be about at 50, so at the no growth line. Minutes from the last Fed meeting, and finally PCE inflation should be at 0.3% month over month, so in the vicinity of where the Fed wants to see it. So that would be good news or positive development if we do see that next week. So that wraps it up for the week. ia.ca/economy. You'll find the content that you need there, podcasts. There are more coming, so all the material that you need is right there. So it's always a pleasure to serve you, and I'll see you again next week.